June 25th, 2002, 8:47 a.m., Washington, D.C. Cynthia Cooper walks into conference room at WorldCom headquarters, hands shaking, USB drive in pocket containing evidence that will destroy one of America's largest companies. $11 billion. That's billion with a B. Numbers she'd found hidden in accounting files over past month. Fraudulent entries, fake profits, made up money that never existed. Outside her office, 20,000 employees starting their day, answering phones, managing networks, building telecommunications. Empire. No idea their jobs will vanish in 30 days. Bernie Ebbers, the CEO, the visionary, the man who built WorldCom from nothing, sitting in his Mississippi ranch, retired 3 months earlier with golden parachute. Also no idea federal agents will arrest him in exactly 18 months. How does an $11 billion fraud happen at America's second largest long-distance phone company? How do auditors miss it for 3 years? How does a company worth $180 billion collapse in 10 weeks? This is WorldCom. This is the largest bankruptcy in American history until 2008. This is what happens when growth becomes religion and accounting becomes fiction. But this isn't just about telecom or .com history. If you had in 2002, Vanguard 500 Index Fund, WorldCom was number 14 holding, 0.8%, and the S&P 500 Fund, WorldCom mandatory inclusion, state pension in California, New York, or Florida. Your fund owned WorldCom. Automatically, no choice. When WorldCom collapsed, CalPERS, California Public Employee Pension, lost $565 million in one day. New York State Pension, $300 million. That's teachers, firefighters, nurses, people who did nothing wrong. If you remember June 2002 and checking your 401k statement, seeing it down 8 to 12%, half that drop? WorldCom, $72 billion lost by ordinary people who trusted the numbers. Let me show you how accounting fraud works and the 3 warning signs every investor missed. But first, understand the pattern. This wasn't the first accounting fraud. It won't be the last. There's a pattern that repeats whenever companies grow too fast and investors demand too much. Stage 1, aggressive growth. Company expands faster than profits justify. Debt piles up. Market loves it. Stage 2, the slowdown. Growth stalls. Profits weaken. CEO can't admit reality. Stage 3, the lie. Start cooking books, move expenses, inflate revenue, just temporary, just until business improves. Stage 4, the spiral. One quarter's lie requires next quarter's bigger lie. Can't stop. Too deep. Stage 5, the collapse. Whistleblower finds evidence. Auditors forced to look. Truth emerges. Company dies. Enron followed this. $74 billion lost, 20,000 jobs gone. CEO died in prison. Health South followed this. $2.7 billion fraud. CEO got 6 years. Company survived barely. Tyco followed this. $600 million stolen. Executives convicted. Shareholders lost billions. Same pattern. Different names. Same result. In 1999, WorldCom entered stage 2. Growth slowing. Profits weakening. Bernie Ebbers couldn't accept it. Let me show you what happened next. To understand WorldCom's collapse, you need to understand telecommunications in the 1990s. If you remember the .com boom, the internet frenzy, new economy hype, tech stocks doubling monthly, telecom companies were the infrastructure making it possible. Back when you'd hear that screech of dial-up modem connecting, when You've Got Mail was exciting, when businesses still used fax machines, someone had to build those networks, lay those cables, connect those servers. WorldCom became that someone, started 1983 as LDDS, Long Distance Discount Services, small company in Mississippi offering cheap long-distance calls. Remember when long-distance calls cost money? When you'd wait until after 9 p.m. for cheaper rates? When calling across country was expensive? AT&T dominated then, charged high prices. Smaller companies found tiny profits in undercutting them. Bernie Ebbers ran it, former basketball coach and milkman, no technology background, but understood one thing perfectly: growth through acquisition. Here's how it worked. Buy a smaller telecom company, add their customers to yours, tell investors revenue growing, stock price rises, use high stock price to buy next company. Repeat. Between 1991 and 1997, WorldCom acquired 65 companies. 65. Each acquisition made WorldCom bigger on paper. Revenue climbed. Investor excitement grew. Stock soared. But there was a problem nobody wanted to see. Many of those acquired companies, losing money, overlapping systems, redundant networks, integration costs enormous, didn't matter. As long as revenue growing, even through acquisitions, not actual business, Wall Street cheered. The biggest acquisition came 1998. MCI Communications, $37 billion. At the time, largest merger in American history. Suddenly, WorldCom controlled 20% of all internet backbone traffic. Second largest long-distance carrier behind AT&T, 80,000 employees worldwide, $180 billion market value. Bernie Ebbers became billionaire. Business magazines called him visionary. Telecommunications, revolutionary. If you had retirement savings in mutual funds during late 1990s, you owned WorldCom. Fund managers couldn't avoid it. Too big, too important, too much growth. Back when you could call investor relations and talk to a real person, when annual reports came in mail printed on real paper, when you trusted big companies because they'd been around forever, WorldCom seemed solid, established, safe. But underneath the surface, fundamentals weakening. Telecommunications industry changing, competition intensifying, long-distance rates, WorldCom's core business falling fast, cell phones emerging, internet calling starting, profit margins shrinking. 1999, first cracks appeared, growth slowing, not collapsing, but slowing, from 30% annually to 15%. For normal company, 15% growth spectacular. But WorldCom built on growth story. Investors expected 30%. Analysts projected 30%. Stock price assumed 30%. This is stage 2, the slowdown. Remember, this is where honest CEOs admit reality. Bernie Ebbers chose different path. Bernie Ebbers couldn't accept slowdown, wouldn't accept it, because he had personal problem, margin loans. He'd borrowed $400 million against his WorldCom stock to buy other investments, timber companies, yacht building business, a ranch, a hockey team. If WorldCom stock fell, banks would demand more collateral. He'd have to sell stock. Selling would push stock lower. Death spiral. His fortune depended on WorldCom's stock price staying high. So growth had to continue. Numbers had to impress. Reality didn't cooperate. This is stage 2, the slowdown, the moment of truth. When honest CEO admits growth phase ending, company maturing, profit still strong but expansion slowing. Bernie Ebbers didn't choose honesty. He chose accountants who would make numbers work. The first lie started small, almost defensible. Late 1999, WorldCom's finance team reviewing quarterly results. Problem, expenses too high. Specifically, line costs, and what WorldCom paid other telecom companies to use their networks. Think of it like toll roads. WorldCom's calls traveled across many networks. Each network charged fees. Those fees were expenses. Expenses reduced profits. David Myers, the controller, and Scott Sullivan, the CFO, faced dilemma. Actual line costs, $4 billion that quarter. Expected line costs, $3.4 billion. Difference, $600 million. That $600 million meant missing earnings target. Missing target meant stock falling. Falling stock meant Bernie's margin loans in trouble. Scott Sullivan made decision. Reduce the line costs. Not actually reduce them, expense already incurred. Just reduce how they reported them. Move $400 million from expenses to capital expenditures. This is stage 3. The lie begins. This is the point of no return. Every major fraud starts exactly here. Here's difference. Expense reduces profits immediately, shows up on income statement, investors see it. Capital expenditure spreads over years. Assets on balance sheet, investors don't notice. Same money, different category. Instant profit boost. David Myers hesitated. Is this legal? Scott Sullivan. Gray area, aggressive, but we're investing in network. We'll fix it next quarter when business improves. Next quarter, business would improve. Growth would return. They'd correct the entry quietly. Classic stage 3 thinking. Just temporary. Just until things get better. David Myers approved the entry. $400 million disappeared from expenses. Reappeared as assets. WorldCom's quarterly profit. $600 million instead of $200 million. Stock price held steady. Bernie's loan safe. Wall Street happy. Nobody caught it. Not internal auditors. Not Arthur Andersen. Their external auditor. Not the SEC. This was the moment. The point where stopping would have meant embarrassment, but not catastrophe. They didn't stop. Because next quarter, same problem. Business still slow, expenses still high. Can't suddenly report honest numbers. Would show previous quarter was lie. So they did it again. Bigger this time. Quarter after quarter. Throughout 2000, throughout 2001. Total move from expenses to capital expenditures. $3.8 billion. $3.8 billion in fake profits. Remember this number? $3.8 billion. We'll see it again. Let's do the math on this fraud. Honest accounting. Real profit, 2000 to 2001. Loss of $1.2 billion. What they should report, $1.2 billion loss. Fraudulent accounting. Reported profit, 2000 to 2001, $2.6 billion. Fake money added, $3.8 billion. The gap, $3.8 billion that never existed. Where was that money? Nowhere. Pure fiction. Accounting entries with no reality behind them. But investors bought stock based on those profits. Pension funds paid dividends believing those numbers. You, if you owned mutual funds in 2000, likely owned WorldCom based on fake profits. They knew. Numbers don't lie. Accountants do. Meanwhile, Bernie Ebbers borrowing more against WorldCom stock, up to $400 million in margin loans. His lifestyle depended on the lie continuing. And Scott Sullivan, the CFO, making these entries. His compensation tied to stock price. Bonuses based on hitting targets. The fraud made him wealthy. Same pattern you see in every major fraud. Personal incentives align with dishonesty. Short-term solution becomes long-term trap. What starts as temporary becomes permanent. By late 2001, entire finance department involved. Not everyone knew full scope, but core team did. Betty Vinson, mid-level accountant, ordered to make entries. She objected. Scott Sullivan told her, "Just this once, I'll take responsibility." She made the entries. Then next quarter, one more time. She made them again. By third quarter, she understood. This was fraud. But she'd already participated. Quitting meant admitting guilt. Staying meant hoping they'd somehow fix it. Classic trap. First compromise makes next easier. Soon you're too deep to escape. Let's compare 4 major accounting frauds from this era. Enron, 2001. First warnings. 1999. Analyst questions energy trades. Collapse, December 2001. Gap, 2 years regulators. SEC after bankruptcy. Outcome, $74 billion lost, 20,000 jobs. CEO life sentence. WorldCom, 2002. First warnings, 2000. Growth slowing, questions rising. Collapse, June 2002. Gap, 2 years regulators. SEC after bankruptcy. Outcome, $180 billion lost, 20,000 jobs. CEO 25 years. Tyco, 2002. First warnings, 2000. Acquisition questions. Collapse, September 2002. Gap, 2 years regulators. SEC investigation forced by media outcome. $600 million stolen. CEO 25 years. Stock crashed 80% health south. 2003. First warnings. 2002. Earnings too consistent. Collapse, March 2003. Gap, 1 year visible. 5 years total fraud. Regulators. FBI raid based on whistleblower. Outcome, $2.7 billion fraud. CEO 6 years. Company survived. Notice the pattern? Warnings always appear 1 to 2 years before collapse. Always. Regulators always arrive after damage done. Always. Timeline never changes. Only names change. December 2001. Enron collapsed. Accounting fraud. Arthur Andersen, their auditor, implicated. Same Arthur Andersen auditing WorldCom. Suddenly, accounting scrutiny intensified. Analysts asking harder questions. Auditors nervous. WorldCom had one advantage. Their fraud simpler than Enron's. No off-balance sheet partnerships. No complex derivatives. Just simple expense reclassification. Hard to detect, unless specifically looking. But someone was about to look. March 2002. Bernie Ebbers forced to resign. His margin loans finally caught up. He'd borrowed too much. Banks demanding repayment. Board pushed him out. He left with $1.5 million annual retirement package. Severance worth tens of millions. But his departure raised question. If visionary CEO leaving, what's real condition of company? Analysts started digging. Stock falling. Moody's considering credit downgrade. And inside WorldCom headquarters, internal audit department deciding to investigate. Led by Cynthia Cooper, vice president of internal audit. If you've worked in corporate America, you know internal auditors. They check expense reports, verify petty cash, make sure procedures followed. Not supposed to catch billion-dollar frauds. External auditors, Arthur Andersen responsible for that. But Cynthia Cooper noticed something odd in capital expenditure accounts. Numbers too large, too smooth, too consistent. She asked CFO Scott Sullivan for explanation. He told her, proprietary accounting methodology, complex, you wouldn't understand. External auditors approved it. Classic deflection. Accounting too complicated for auditor to understand. Red flag. She kept digging, late nights. After CFO's team went home, she and small team reviewing files. May 2002, she found it. Billions in line costs reclassified as capital expenditures. No documentation, no authorization, no business justification. She brought evidence to Scott Sullivan privately, gave him a chance to explain. He told her, stop the audit, not your area, you're overstepping. She said, I report to audit committee, they'll decide. He said, "I'll have you fired," she said. "Then fire me." Instead, she went to audit committee. Board members showed them the entries. Their reaction: "How much?" "At least 3.8 billion. Maybe more as I keep looking." Silence. Then, "We need external verification." They called KPMG, different auditor, to investigate independently. June 24th, 2002, KPMG confirmed. Massive accounting fraud. Multiple years, multiple billions. Next morning, June 25th, WorldCom announced to public, "We have discovered accounting irregularities." Stock price, already falling, collapsed. From $60 per share in 1999 to $9 that morning to under $1 by week's end. Here's how the fraud actually worked at scale, how billions moved without anyone noticing. WorldCom's accounting system had 40 different databases, legacy systems from all those acquisitions. Nobody had single complete picture. Scott Sullivan used that complexity. Each quarter, here's what happened. Step 1, finance team calculated real results. Revenue, expenses, profit or loss. Step 2, if profit too low, Sullivan told team, "We need to find entries to adjust." Step 3, team identified line costs to reclassify, moved hundreds of millions from expense accounts to capital accounts. Step 4, entries made in different databases, spread across systems, hard to track. Step 5, summary numbers reported to executives and investors. Clean, simple, profitable, money laundering basically, but with accounting entries instead of cash. And Arthur Andersen, the auditor, paid millions to catch exactly this kind of fraud. They relied on summaries, didn't drill into databases, didn't question capital expenditure growth. Why would they? WorldCom expanding. Capital spending on network growth made sense, except it wasn't real spending, just reclassified expenses. Let's do the math on the scale. Total fraud, as eventually discovered. Line cost capitalization, $3.8 billion. Revenue inflation, $2.0 billion. Other accounting tricks, $5.2 billion. Grand total, $11 billion. $11 billion of fake profits over 3 years. To put in perspective, more than annual budget of 10 states combined. Enough to fund Social Security benefits for 5 million people for a year. Double entire revenue of competitor AT&T Wireless One Company. $11 billion in fiction. They created profits from nothing. Math proves it. Meanwhile, Bernie Ebbers, even after resigning, living like king. 500,000-acre ranch in British Columbia. Luxury yacht, timber business, Louisiana Lumber Company. All purchased with loans backed by WorldCom stock. Stock price inflated by fraud he demanded. Scott Sullivan, $7 million salary 2001, plus stock options worth tens of millions. Betty Vinson, the reluctant accountant, she made entries to keep her job. Salary, $80,000, no bonuses, no stock windfalls. When fraud collapsed, Bernie and Scott had millions stashed. Betty had mortgage and retirement account invested in WorldCom stock. By early 2002, warning signs everywhere. If anyone wanted to see them. January 2002. Stock analysts questioning growth rates. Why capital spending so high when revenue flat? February 2002. Credit rating agencies concerned. Debt levels rising. Cash flow weak. March 2002. Bernie Ebbers forced out. New CEO appointed. John Sidgmore. The first question he asked, CFO, are the numbers real? Scott Sullivan, absolutely. But internally, pressure building. Arthur Andersen, WorldCom's auditor, under siege after Enron collapse. Justice Department investigating them. They couldn't afford another scandal. March 2002, they told WorldCom, "We need more documentation, need to verify these capital expenditure entries." Scott Sullivan stalled. Complex systems, takes time to pull reports. Weeks passed. Andersen kept asking. Sullivan kept delaying. Then Cynthia Cooper started her investigation. May 2002, she worked nights. Had to. Couldn't let CFO's team know what she was finding. Her small audit team, Gene Morse and Glenn Smith, helped. Pulled files after hours, traced entries across databases. Remember, we're at stage 4 of 5, the spiral. What comes next is collapse. Always happens. Timeline never changes. One night, she found entry for $500 million. Line costs reclassified as prepaid capacity. No contract, no vendor, no documentation, just entry moving expense to asset. Next night, another $800 million. Same pattern. She called board member anonymously. "You need to look at capital expenditure accounts. Something seriously wrong." Board started asking questions. Scott Sullivan got defensive. May 28, 2002, Cynthia presented preliminary findings to board's audit committee. Expected resistance. Expected them to protect management. Instead, Audit Committee Chair Max Bobbitt said, "Keep digging, find everything, we'll protect you." Sullivan found out, called her to his office. "Stop this investigation, you're damaging the company, scaring investors." She said, "I report to Audit Committee. They want me to continue." He said, "I'll have you fired." She said, "Try." Timeline tightening. June 10th, 2002. External auditor KPMG brought in. Independent review begins. June 20th, 2002. KPMG finds $3.8 billion in fraudulent entries. Remember that $3.8 billion I mentioned? This is it. Number keeps growing as they dig. June 24th, 2002. Board fires CFO Scott Sullivan and Controller David Myers. June 25th, 2002, 8:47 a.m. WorldCom announces accounting irregularities to public. Exactly where this story started. Stock price that morning, 83 cents per share, down from $64 just 3 years earlier. Market capitalization, $150 million, down from $180 billion peak. If you had $10,000 in WorldCom stock at peak, now worth $55. 55? 20,000 employees arriving at work, answering phones, managing networks. No idea their paycheck's about to stop. June 25th, 2002, 9 a.m. Eastern. WorldCom's announcement hit newswires. Company has discovered approximately $3.8 billion in accounting irregularities. Wall Street's reaction? Immediate panic. 9:30 a.m., NYSE halts WorldCom trading. Stock frozen at 83 cents. 10 a.m., competitors' stocks falling. If WorldCom cooking books, who else? 11 a.m., telecom sector losing $50 billion in market value. One announcement, $50 billion gone. By noon, WorldCom's major customers, businesses depending on their network, scrambling for backup providers. 48 hours later, rating agencies downgraded WorldCom debt to junk status. Billions in bonds suddenly worthless. 72 hours later, banks declared WorldCom in default on $30 billion in loans. Payment immediately due. WorldCom didn't have $30 billion, didn't have $3 billion, had maybe $300 million in available cash. 1 week later, investigation expanded. Not just line costs. Revenue fraud discovered too. Fake sales, inflated contracts, more billions. Total fraud growing. Remember that $3.8 billion from line costs? That was just the start. Then $6 billion, then $9 billion. Eventually, $11 billion total. $11 billion. That's billion with a B, more than most countries' annual budgets. July 21st, 2002, exactly 26 days after announcement, WorldCom filed Chapter 11 bankruptcy, the largest bankruptcy in American history, surpassing Enron by $40 billion. Assets, $107 billion. Debt, $41 billion. The gap, accounting fraud. Let's count the final damage. Direct investor losses, stock value destroyed, $180 billion. Bondholder losses, $30 billion. Subtotal, $210 billion. Jobs destroyed. WorldCom employees, 20,000 laid off supplier/contractor jobs. Estimated 30,000 plus total 50,000 plus jobs. Pension fund impact. CalPERS, California Public Employees, $565 million lost State of New York pension, $300 million lost Florida state pension, $280 million lost, hundreds of smaller funds, billions more when fraud. $11 billion, 200,000 lives destroyed. Real people, real retirement money, real lives destroyed. Robert Smith, 58, Jackson, Arn, Mississippi. WorldCom engineer for 19 years. Pension, $380,000 in WorldCom stock. After bankruptcy, $4,200. Quote from interview, "I thought I was set. Company stock in my 401k, safe job. Now I'm delivering pizzas at 58. His story repeated 20,000 times. August 1st, 2002, FBI raids WorldCom headquarters. Boxes of documents seized, hard drives copied. September 2002, Arthur Anderson, WorldCom's auditor, convicted of obstruction in Enron case. Firm dissolved. 85,000 employees worldwide lost jobs. Same auditor for Enron and WorldCom. Both frauds, both missed. March 2003, Bernie Ebbers indicted. Securities fraud, conspiracy, making false statements. He claimed innocence. I'm not an accountant. I trusted my CFO. I didn't know about the fraud. Prosecutors. You demanded the growth. You created the pressure. You knew. September 2003, CFO. Scott Sullivan pleaded guilty. Agreed to testify against Ebbers. Faced 25 years. Hoped for leniency. March 2004, Controller David Myers pleaded guilty. also agreed to testify. January 2005, Bernie Ebbers' trial began. Manhattan Federal Court. Prosecution's case? He knew. Regular meetings with Sullivan. Saw the numbers. Demanded they hit targets by any means necessary. His margin loans created motivation. Defense, CFO acted alone. Bernie trusted him. CEO can't know every accounting entry. March 15th, 2005, exactly 1,090 days after the fraud announcement, jury verdict, guilty on all counts. July 13th, 2005, sentencing 25 years in federal prison. Bernie Ebbers, 63 years old. Sentence effectively life. Judge Barbara Jones. I find a sentence of anything less would not reflect the seriousness of this crime. Ebbers' wife sobbed. His children watched. He showed no emotion. He'd built a $180 billion company from Mississippi startup. Made billions, lost everything. Died in prison February 2nd, 2020, age 78, served 13 years. Scott Sullivan, the CFO who made the entries, sentenced to 5 years, served 4.5, released 2009. David Myers, the controller, sentenced to 1 year and 1 day, served 9 months. Betty Vinson, the accountant ordered to make entries, sentenced to 5 months, lost her career, lost her savings, invested in WorldCom stock. The others who participated, sentences from probation to 3 years. Total sentenced, 8 executives and employees. Total who lost jobs, 20,000. Total who lost savings, millions of investors. After bankruptcy, what happened to WorldCom? Company restructured. Emerged from bankruptcy April 2004 as MCI Incorporated. Dropped the WorldCom name. Too toxic. Required $6 billion in debt forgiveness, new management, completely new board of directors. Stricter oversight, regular audits bondholders. Recovered 36 cents on the dollar, lost $20 billion permanently. Stockholders? Recovered nothing. Complete loss. If you owned WorldCom stock, it went to zero. The company itself survived in diminished form. Verizon acquired MCI in 2006 for $8.5 billion, less than 5% of WorldCom's peak value. The WorldCom brand died. Networks sold. Employees scattered. Who paid for the collapse versus who escaped? Paid. 20,000 workers. Jobs. Pensions. 401s destroyed millions of investors. $180 billion in losses. Pensioners. Billions in retirement funds vanished. Suppliers. Billions in unpaid bills escaped. Bernie Ebbers kept his ranch, eventually sold, but lived there during trial. Scott Sullivan, out of prison 2009, working in private sector. Arthur Anderson Partners, firm dissolved, but individuals kept personal wealth. Early investors who sold 1999 to 2000 made billions before collapse. Pattern you see everywhere. People who caused crisis, prison or early retirement. People who enabled it, moved to other firms. People who paid, ordinary workers. And savers who did nothing wrong. If this sounds familiar, it should. Same pattern 2008 financial crisis. SIEC responded to WorldCom with regulations. Sarbanes-Oxley Act passed July 2002, 1 month after WorldCom announcement. New rules. CEOs must personally certify financial statements. Stricter auditor independence. Whistleblower protections, criminal penalties for fraud. Every public company CEO now signs financial statements. If fraud discovered, can't claim I didn't know. Direct response to Bernie Ebbers' defense. Accounting profession reformed. Arthur Anderson gone. Remaining Big Five became Big Four. Stricter rules on consulting while auditing. Cynthia Cooper, the internal auditor who exposed fraud, named Time Magazine Person of the Year 2002, along with 2 other corporate whistleblowers. She kept her job through bankruptcy. Left WorldCom 2005. Wrote book. Became advocate for ethical accounting. Last major update, 2019. WorldCom's bankruptcy record broken by Lehman Brothers, 2008. Pattern continued. So what does WorldCom teach? Not just about telecom or accounting, about human nature, pressure, and systems that should protect ordinary people's savings but don't. Lesson 1. Growth at any cost cultures breed fraud. WorldCom's identity built on one thing, growth. Every quarter had to beat last. Every year had to be bigger. When natural growth stopped, telecom industry maturing, competition intensifying, company faced choice. Accept reality. Tell investors, growth phase ending. We're now mature, profitable company with stable returns. Or lie. Make numbers work on paper even when reality didn't cooperate. They chose lies. Same pattern. Enron, Tyco, Health South. All same era. All growth obsessed, all collapsed. If you have retirement, savings, and actively managed funds or individual stocks, watch for these red flags. Red flag number 1, growth too fast. Company growing 30% when competitors grow 5%. Unsustainable. Either lying or headed for crash. Red flag number 2. Buying spree. Buying other companies every quarter usually means hiding weakness in core business. Red flag number 3. CEO. Personally desperate executive has huge personal loans backed by company stock. Will do anything to keep stock price up. Our red flag number 4. Accounting gets creative. Company starts using adjusted earnings or pro forma profits. Translation. Real numbers look bad, so we made up better ones. Remember, sustainable 15% growth beats fraudulent 30%. Every time. Real growth shows in cash flow. Fake growth hides in accounting. If you have adult children or grandchildren with 401s or investment accounts, send them this. These red flags could save their retirement. Lesson 2. Auditors with conflicts can't be trusted. Arthur Andersen earned $16.8 million annually from WorldCom. Auditing fees, $4.4 million. Consulting fees, $12.4 million. They made 3 times more from consulting than auditing. Who pays your salary controls your independence. If auditors' income depends on keeping client happy, they won't ask hard questions. This isn't unique to Andersen. Enron. Andersen earned $52 million annually, mostly consulting 2008 crisis. Rating agencies paid by banks, they rated A ratings on junk mortgages. Theranos, Walgreens partnership prevented skeptical analysis. Until conflicts eliminated, pattern repeats. If you care where pension money invested, ask fund managers. Who audits companies you invest in? Do those auditors have consulting conflicts? Most won't know, that's the problem. They're trust earned through independence, not through fees. Lesson 3. Whistleblowers save billions, but pay personally. Cynthia Cooper did right thing, found fraud, reported it, saved investors from deeper losses. Her reward? Death threats, hate mail. Colleagues ostracized her. Traitor who destroyed the company. Wrong. Fraud destroyed company. She exposed it. But whistleblowers always get blamed. Easier to shoot messenger than accept ugly truth. Corporate culture punishes honesty, rewards loyalty, even loyalty to lies. Result? Next potential whistleblower sees what happened to Cynthia. Stays quiet. Billions more lost. Until whistleblowers protected, truly protected, not just legally but culturally, frauds will continue. If you see fraud, you face choice, career or conscience. Most choose career. Can't blame them. System needs to change. Know someone in finance, accounting, or corporate management? They need to hear Cynthia Cooper's story. Share this. This pattern isn't finished. Right now, January 2025, watch these companies showing WorldCom-style warning signs. Palantir Technologies, PLTR, trading at 50 times revenue, 0 sustained profits, stage 2 warning, revenue growth slowing, 30% in 2023, projected 20% in 2025. Adjusted earnings exclude stock-based compensation, $500 million plus annually. If Q2 2025 shows operating cash flow negative while reporting adjusted profit, stage 3 confirmed snowflake, snow, 30 times revenue, multiple with declining growth, burning through cash, minus $200 million. Operating cash flow, 2024, heavy stock-based compensation hidden in non-gay AP earnings. Watch. If they change CFO in 2025 without clear explanation. Red flag, specific warning timeline. If pattern holds, and it always does, one of these shows accounting irregularities by mid-2026. Watch for these specific events. Delayed 10K filing, annual report, late equals stage 3 critical. Check sec.gov, greater than company filings, greater than 10K due dates, CFO, sudden resignation, stage 4, red alert. Google, company name, CFO resignation. Monthly auditor, change without explanation, stage 4, final warning. Annual report, page 2, lists auditor. If changes, question why, how to track yourself. Go to Yahoo Finance, type ticker symbol. Click Financials tab. Compare net income versus operating cash flow. If GAAP exceeds 30% for 3 consecutive quarters, WorldCom pattern starting historical precedent. On WorldCom, warning signs, visible 2000, collapse 2002. GAAP, 2 years. Theranos, problems visible 2014, exposed 2015. GAAP, 1 year. FTX, warning signs 2021, collapse 2022. GAAP, 1 year. We're in early 2025. Pattern says next collapse, late 2025 or 2026. I'll be watching Palantir's Q2 2025 cash flow statement. If operating cash flow stays negative while adjusted earnings stay positive, classic fraud setup. You can track it too. Yahoo Finance greater than PLTR, greater than cash flow, greater than operating cash flow line. Pattern never fails. Only question, which company first? Here's uncomfortable truth. System that enabled WorldCom hasn't changed fundamentally. Executive compensation still tied to stock price incentivizes short-term manipulation. Auditors still earn more from consulting than auditing. Incentivizes looking away. Regulators still underfunded and reactive. Arrive after damage done. Different decade, different industry, same playbook. Sarbanes-Oxley added rules. Good, but rules don't change human nature. Greed, pressure, fear of failure, ego, those don't change until incentives align with honesty, until doing right thing more profitable than fraud. Pattern continues. June 25th, 2002, 8:47 a.m. Cynthia Cooper walked into that conference room, hands shaking, evidence in pocket that would destroy her company, 20,000 jobs about to end, billions in savings about to vanish. Her colleagues, people she'd worked with for years, would lose everything. She knew all that. Did it anyway. I'd say it's because numbers don't lie. $11 billion doesn't just disappear. Someone put it there, on purpose, for years. Bernie Ebbers told friends he was victim, scapegoat for CFO's crimes. I'm not an accountant. How could I know? But he knew. He created the pressure. He demanded the growth. He borrowed hundreds of millions against stock price he knew was inflated. Then, when it collapsed, he acted surprised. He got 25 years, died in prison. Some say that's justice, but 20,000 workers who lost jobs and pensions, they didn't create fraud, didn't demand fake growth, didn't profit from lies. They paid anyway. A pattern you see in every major corporate fraud. Architects serve time or escape with wealth. Enablers move to next company. Victims, workers, pensioners, small investors lose everything. Our system that created WorldCom still exists. Pressure to grow. Executives compensated on stock price. Auditors with conflicts. Regulators underfunded. Next WorldCom already forming somewhere. Different industry, different name, same forces. Here's what I'm tracking. You can track it too. Every quarter takes 2 minutes. Step 1, go to Yahoo Finance, yahoofinance.com. Step 2, type PLTR in search box, that's Palantir. Step 3, click Financials tab, then Cash Flow. Step 4, look at Operating Cash Flow line. If negative for 3 straight quarters, while company reports profits, warning. If gap growing each quarter, danger. If exceeds minus $300 million, critical. I'm specifically watching their Q2 2025 report, releases late July 2025. If that operating cash flow number hits minus $400 million or worse, while they announce record adjusted profits, pattern confirmed. Stage 3, write this down. Yahoo Finance greater than PLTR, greater than cash flow, greater than check quarterly. Could take 2 minutes to save your retirement. Pattern says it's coming. History says we won't learn until money's gone. Because $11 billion fraud wasn't first, won't be last. Only question, who's next?